Hello viewers, welcome back to UPSC Warriors channel by Unacademy. This is Soundarya. In today's video, we are going to discuss the key decisions taken during the last Monetary Policy Committee meeting happened yesterday, and also we are going to learn some of the key terms that are related to it. So without much delay, let's start the discussion now. The key decisions made include reducing the cash reserve ratio after a long period of time by 50 basis points. This is something which is actually going to significantly impact the liquidity in the market, whereby the banks will now have extra money to inject into the system. So why it is so? It is mainly because the cash reserve ratio is something that the banks have to keep with RBI so as to have some kind of backup in case of bankruptcy or in case of any financial crisis, right? So what is basically cash reserve ratio? It is the certain percentage of the bank's net demand and time liabilities that it has to keep in reserve with the bank, and that is actually in the form of cash. That is why we say that this is the cash reserve ratio. So by controlling the percentage of the bank's net demand and time liabilities that it has to maintain with the RBI will be able to control the money supply in the market. It is very simple like this. You are keeping certain percentage of your total, money that you have in the locker at your home, and then spending the rest of the money so as to use that reserve in case of crisis. So by controlling the amount of money that you should keep it as a reserve, you will be able to actually control the amount of money that you are left with for spending, right? So whenever RBI is reducing the cash reserve ratio, then banks will have extra money with it, and that extra money can be used for lending. So when that extra money is used for lending, obviously it will create some kind of economic activity. Probably the amount of loans that the banks are going to lend will increase, so that will again help people to get loans from the banks, and that will help us to help them to start any business. So that is how the economic activity is getting controlled, right? Now we will come back to the discussion where we will actually discuss why the RBI has reduced CRR and what are the other decisions that was taken during this meeting. Now let us try to understand this CRR first. So what is mean by CRR? As we already discussed, it is the percentage of banks' net demand and time liabilities. So what is mean by net demand and time liabilities? It includes the fixed deposits that are there with the bank. It includes the current account deposits. It includes the savings account deposits. So these are certain type of deposits which the bank will have it with themselves, but these are liabilities also, right? So whenever we demand our money from the banks through our deposits, the bank has to give the money, right? So these are kind of liabilities, but although it is a liability, banks will use these deposits for creating money, will use these deposits for lending loans, will use these money for the activities of the financial activities of the banks. But then if it is using every money of the deposits that it has, then in case if it is not able to repay us back whenever we demand a deposit, as in the case of demand deposits, then the bank will be in trouble, right? So for that reason only, RBI wants the banks to keep certain percentage of the total, that is the net demand and time liabilities, as reserves in form of cash with the RBI. So this is all about CRR. Now what is going to happen when the CRR is getting reduced? Then it is going to inject liquidity into the banking system. That is enable more money to get injected into the economic activity. Clear? So this is done with respect to the consideration of the factor that our economy is going through slowdown, where we find from the newspapers recently that the manufacturing activities and the consumer demand is not that much good, right? Keeping in mind about the current economic condition, the RBI has RBI has taken this decision of reducing the CRR. Moving forward from here, so let us take the example. If the bank has a total deposit of 100 crores, then if the CRR rate is 4%, then the bank has to make 4 crore deposits in cash with the RBI. So this is how CRR is working. Now, what are the other decisions taken? So we know that reducing the CRR is something likely to inject about 1.16 lakh crore into the market, which is currently held as reserves with the RBI. What are the other measures taken? The repo rate, which is the key policy rate, was kept unchanged at the rate of 6.5%. If you are someone who is following the monetary policy decisions taken in the recent times, this is something which is being maintained consecutively for a long period of time. Why? Because RBI is concerned about the inflation. So what is this repo rate? We learned repo rate is nothing but the rate at which RBI will lend loans to the commercial banks, right? So it is the rate at which RBI is going to lend loan to the commercial banks which are facing shortage of funds. So at what rate? At the rate of repo. So how this is related to inflation? This is related to inflation because whenever the RBI is reducing the repo rate, the banks are expected to reduce the rate of interest that it is charging for house loan, that it is charging for car loan, other property loans, etc. Why? It is because this repo rate is something that is linked to what? External benchmark lending rate. So what is external benchmark lending rate? This is the rate below which banks cannot offer loans to the customers. So why do RBI is either going for increasing or decreasing the repo rate? It is because if the RBI is increasing the repo rate, it is expected that the banks will also charge higher interest rates from the customers. So when the banks are charging higher interest rate from the customers, then it is quite obvious that the number of loans being taken is going to get reduced, right? If not the number of loans, then obviously the people will be left with less amount of money that they can actually spend on purchasing some other kinds of goods and services after paying higher interest rates. So if I am someone who has taken a house loan and if RBI is increasing the repo rate, then the banks will have to pay higher rate of interest to RBI. So banks will obviously increase my rate of interest that I have to pay for my house loan. So if the interest rates are higher, then probably I will have to spend extra money every month for making the interest payments. If I am spending extra money towards making interest payments, then probably I will have less money with me for purchasing other goods and services. In that case, the demand for goods and services is going to get decreased. So when the demand for goods and services is getting decreased, then it will obviously help in maintaining the price of goods and services. Why? If the demand for the product is higher, then that can lead to increase in price of the product, leading to inflation. Clear? So this is something that is happening on a large scale as well. So whenever the RBI feels that the inflation is high in the economy, it will not go for increasing the, it will not go for decreasing the repo rate, right? So when the repo rate is decreased, what is going to happen? Banks will also decrease the interest rates. Then I will be having extra money in my hand so that I can demand some goods and services. That will lead to inflation. So depending upon inflation, RBI will either go for decreasing the interest rate or increasing the interest rate. If the inflation is too less in the economy, it means the demand is too less. So when the demand is too less, then it means the production will decrease. So when the production is less, then the economic growth will decrease. So in such situations, in order to boost production, in order to boost growth, RBI will go for decreasing the repo rate. So this repo rate is something called as the policy rate, and it is one of the key policy tools used by the RBI to control inflation and money supply. So when we are dealing monetary policy unit in detail, I will be discussing about the quantitative and the qualitative tools being used by the RBI to control the money supply. So this is what happens with respect to the repo rate. As you can see from this diagram that about 44% of bank loans are linked to the repo rate. So this is the figure that shows how much amount of significance this repo rate holds. Clear? And now moving forward from here, so it means that since the RBI finds it difficult to reduce the repo rate because of the higher food inflation that we have right now, it has maintained the neutral stance. That is, it did not go for decreasing the repo rate. In that case, what is going to happen to your EMI? It is not going to get increased. Of course, if it is a variable EMI, it is not going to get increased. And moving forward from here, so this is the image of India's inflation surge in recent times. You can see here that the food inflation is very, very high right now, right? So this is the main reason cited by the RBI governor to not, decrease the interest rate in the latest MPC meeting. And then apart from this, RBI has changed the growth projections that it had for India. So now the policy panel cut the GDP growth estimate to 6.6% in the next year as compared from 7.2% projected earlier because of the other factors that we discussed before. And then it also raised the retail inflation to 4.8% from 4.5%. So this is the projected, growth rate of the country as well as the inflation. So RBI has made changes to both. It has reduced the growth rate estimate and it has also made changes to the inflation estimate as well from 4.5% to 4.8%. Okay, so and then RBI has also introduced a very important thing called as mule hunter. So this is nothing but an artificial intelligence, and machine learning based infrastructure which is going to help especially small banks to target and attack this mule accounts. We know what is mean by mule accounts, right? Fake accounts being used for making illicit transactions, and that is something a very big problem especially right now happening in the banking sector. So this is an artificial intelligence based initiative which is mainly aimed at combating digital fraud, right? And that is mainly happening through mule bank accounts. So this is one such initiative made in the recent MPC meeting. In addition to that, RBI has now allowed the small finance banks to go for credit lines based on UPI, like how it was introduced in the commercial banks in 2023. So these are the key policy outcomes that you have to know from the recent MPC meeting. And now I have something very special to announce, that Unacademy is going to conduct a very, very big event, the named as Pratishta, where we will have so much of fun, so much of things are going to happen in the event. So I wish you all to, take part in the event, and it is going to happen on the 10th of December at 7 p.m. So without fail, I would like you all to join this event and have interaction with our top educators, mega influencers, and this event is going to be one of the biggest event conducted recently by the Unacademy. So this is all for today from my side. Thank you so much for watching. If you have not subscribed to UPSC Warriors channel, please subscribe and stay tuned with us for more updates. Thank you and take care.